Welcome to another episode of the InvestorKit podcast. And as you know, from time to time, I don't like to be just myself in the studio, and I like to have great guests and other people on the show with me. And so today's episode, we're doing something a little bit different, and it's going to be a new theme coming up more often in our podcast episodes. Everyone has been asking us, going, "Hey, Arjun, we saw that you and the team have supported a couple of your clients, those long-standing residential clients of yours who've built out a very successful portfolio, transition to commercial property." And this has kind of been what I call the passive stage of a portfolio. We have three phases of a portfolio: foundation, building major market assets, building larger value-based assets, then turning to momentum, which is where we get affordable properties around the nation, any market, anywhere where the data and the numbers say so, affordable, high yield. And then from there, we move into passive assets, commercials, duplex, triplex, unit blocks, things that bring home the income. And so now we're coming to 6 years as a buyer's agency here at InvestorKit, which means we are taking clients' portfolios through to those final stages. One thing that I'm very blessed for is that the 6 years adding up means that we get to see people's portfolios not just add a property, but actually construct a portfolio that's going to hit their goals. And this is where we are starting to see the elements of commercial property come in a lot more in our client base as we support them to add the final touches to their portfolio to reach their long-term income and wealth building goals. So what does that mean? We're going to have more insights and content for you all on the space of commercial, something that I have over $250,000 in experience in from my time in banking and here in property. I own commercial myself, and we help many clients to do so. But rather than just hear it from me, I wanted to make sure you hear it from the pro in our team for commercial, our head of commercial, Chris. Now, Chris joins us here with experience in many large commercial names. I'll get him to give a little bit of a spill from his angle, and so then he can share more about himself and where his background is. But also, Chris is the lead in helping many of our clients with their commercial acquisitions. So we'll be hearing from him regularly on the show, on the InvestorKit podcast, and talking about more things commercial property, whether it's tips, whether it's mistakes, whether it's growing your portfolio, the pitfalls, and making sure that you make the right decisions with the right data to start or scale a commercial portfolio or add commercial property to your portfolio. So in store for today's episode, we're going to start off this new theme, and we're going to have this as a bit of a once a month or once every other month, just to make sure that you hear from the angles of commercial in case that's where you're heading. And I'll have Chris join us for each of those episodes. And so today we're covering off 5 benefits of investing in commercial property. So if you're new to this or just wanting to learn a little bit more about it, what is happening in that commercial space that makes investors go, this is time for me to consider it. So Chris, welcome to the show, my friend.
Thanks, Arjun. It's always a pleasure to discuss opportunities in the commercial real estate market, especially when we can shed light on why it's such a solid choice for investors.
Well, mate, you are a superstar in the commercial space, but at the same time, many people on this show and our InvestorKit audience may not have heard from you or of you in the past. How about you give us a bit of a breakdown of who Chris is and the experience in the commercial space you bring on?
Yeah, so commercial real estate for me started about 6 years ago. While I was at university, I joined a international valuation company, or a valuation and a broker company called Savills. So while at uni, I studied a bachelor degree of property. And then whilst I was doing that, I was working part-time in research and in vows at Savills. That was before graduating university. And then once I graduated university, I got a graduate program offer to go to Lease to start in their property development program. So I got to work on like big office developments, mixed use projects, and also in the community space. So where your like master plan communities are. That was really great exposure. Did that for 2 years. Then moved to the analytical space, so investment management across Leases, retail and separate mandates portfolios, mainly focusing on shopping center assets. So doing the valuations there, leasing analysis and all that sort of stuff. And then moved to Mirvac for a couple of years, where I was the retail analyst there, the senior retail analyst there, working on the MPT portfolio for retail. So as far as experience goes, yeah, that's sort of my history. And now jumping into the buyer's agency space and purchasing lucrative commercial investments for our clients.
Well, the beauty about that experience, Chris, is there's three things that I see, right? The first is the large names and the large deal sizes, because when you start getting exposure to those large names and large deal sizes, it actually is much the same of those smaller deals, but with less zeros around them and less complexity.
Correct.
So instead of someone who starts at the more entry end and then builds complexity over time, you've taken on, the most complex deals in Australia, and then you're bringing them down to the simpler deals for mums and dads. So then your experience is doubling up in terms of its value.
Correct.
The second thing I heard there, Chris, was about the two most important areas where your experience is deepened, which is leasing and valuations. Because when it comes to commercials, from our side as a research team, we're able to very easily understand macro trends. We're able to understand easily things that are industry level trends. So we can understand when medical is going well or industrial is going better or office, and we can understand what the economies are doing. But there is nothing more valuable than the internal understanding of the most micro parts of commercial, which is the asset. Valuations, leases, right? They make up so much of it. And so thank you, mate. We're really keen to have you not only on the show as a regular feature, but actually a part of the InvestorKit team as our head of commercial as well. And so, mate, let's get straight into it. Today, 5 benefits of commercial property, or 5 key things to learn. What's the first one you want to jump into?
Yeah, so the first key point, or the key benefit, I would say, would be the higher rental returns. Now, Arjun, unlike residential properties, commercial real estate can offer investors net returns of, let's just say, 5.5% or more. What does that mean? In simple terms, net return refers to the income an investor pockets after property expenses are paid, but before interest and taxes. So commercial properties stand out because they often have that higher rent than residential properties, leading to those attractive net returns.
Awesome. And so those net yields, they're obviously a big thing that investors are chasing. When you see the yields, where do you see them typically range from, and where do you see as like, hey, good buying versus amazing buying on the yields front?
Yeah, of course. So we're typically buying 5.5% as a minimum for our investors. That can typically go all the way up to 7%. But what does that mean? That means that generally the higher the return, the higher the risk, the higher the calculator risk, like we like to say. So just to give you an example, something out in Brisbane, close to Brisbane, industrial asset, for instance, let's say 20 minutes east, you're typically seeing yields range from 5 to 5.5%. We would call those very safe assets because they're giving 5.5%. It's not the highest amount you can get, but you usually have robust tenants in that sort of range. When you go up to the 7%ers, for instance, you're typically looking at specialized assets. What do I mean by that is you're looking at something. Let me give you an example. In South Australia, you'll have like a medical asset, for instance, like in Adelaide, like a veterinary clinic, for instance. You'd probably see that vet producing probably 7% net yield. So there's different risks for different rewards, and that's sort of the example that I'll use for that.
Okay. Well, mate, with the specialized assets, I think on the higher ends, sometimes as well, one thing for people to know is that you can still get those higher end yields, but they typically, if not specialized asset, might also be more smaller locations, right? Kind of like how in residential, we have rental yields change as you go to more regional locations. They tend to be a little bit higher. Similar thing in commercial, right? So when it comes to that, mate, on the net yields thing, one more piece I wanted to ask before we go into some of the other benefits you've got. There's obviously assets that are way lower than 5.5% net. And we see many people buy these assets. Why do they buy them? But then also for our clients, why is that not always a good idea too? So I guess it'd be good to understand the both sides of it.
Yeah. So the typical yields you see below the 5.5% is sometimes commercial transactions will transact at 3%. Those are the types of assets like anchored by McDonald's, anchored by a Woolies, for instance, in a neighborhood center. Those are typically your very, very, very safe bets. And those ones are the types of plays people will do with tremendous amounts of cash, or they have, a syndicate backing them. And they typically have very, very, very long leases too. So I'm talking like 10 years plus. So maybe 3% at the beginning of the transacted at 3% net yield, but they'll expect a longer return for that amount of money that they invested over the course of the years to come. So, for instance, it may be 5% yield at year 5, for instance, but they will have those cash buffers to be able to take on that large interest expense, or they'll just pay cash for that.
Yeah, that's actually a really good point, Chris, because this is a good learning for everyone. There is a concept called yield on purchase. And this is a concept that many people forget. And Chris is really, really good at breaking this down. Some people can get really excited by a 7% net yield deal. But then what happens is it could be a slightly inflated rent in a market and an industry type and an asset type that is not actually increasing its pressure for rent ahead. So what that ends up meaning is that whilst rents are strong at starting point, they may grow like this. But then you might have rents at a starting point here on a 5.5%, where yes, we know it's lower, but even though it's lower, the industry's in higher demand, the location's in higher demand, the tenant is more comfortable to pay it, and it's not inflated on its dollar per square. So you might purchase it at here, but then as the years go on, this effect happens, and you get to year 6 here, whereas this did not move up much. And as we know, whilst commercial's a great income game changer, net yields are great to understand, like Chris is breaking down today. We also want to make sure we don't fall in love with the yield at the time, because yield on purchase can change later on, creating a better result longer term. So, Chris, that's number one. Love to know that the net yields are there, and that's why residential investors make that transition. What's point number 2?
Yeah, so point number 2 is longer leases. Now, we know, Arjun, stability is key in any investment, and in commercial leases, often extending to 3 to 10 years, offer just that. And how does this benefit investors? Longer leases mean steady cash flow for predictable period, which is fantastic for long-term financial planning.
Awesome. Awesome. And so, Chris, this is actually a good segue to the point of vacancies. Whilst vacancies are longer in commercial traditionally, it sounds like there's a chance for them to not happen that often, though, based on these lease lengths. Could you more touch into vacancies of commercial too?
Yeah, of course. So it reduces the vacancy turnover you might see in residential investments, where leases typically only last about a year. So, for instance, in residential, a person will sign up for a lease for about a year. They may leave, they may not. But in commercial terms, we would sign up a business, for instance, for 3 years. So for 3 years, you're getting income, and they may even have an option term attached to that, which benefits more the tenant than it does the landlord. But it means the tenant can utilize that option term so they can stay there at the place, so the landlord doesn't have to kick him out, or they can't kick him out, for instance. So that's the reason why longer leases are more beneficial in the commercial space, because it's predictable.
Awesome. Awesome, mate. Well, with longer leases, that's a key point you've touched on, because if you're a residential investor, yes, your your vacancy is far lower, but it could happen technically every year, right? And so if it could happen every year, that could be just as bad as a commercial lease that has 2 5-year terms. One is a 5-year term with an option of 5 years. And then on the 10th year, you have a 3 or 6 month vacancy or a 6 or 9 month vacancy. That's 10 years uninterrupted of rental growth, rents coming through in high cash flows. And then, yes, you might have your 6 to 9 month vacancy, but at the same time, over that 10-year period, you could have had just as much potentially on your residential property, depending on the market conditions. That's number 2, Chris. What's number 3 that you've got in store for us?
Yeah, so minimal maintenance and outgoings. So most commercial leases work in favor of the landlord when it comes to maintenance of the property and its outgoings. Outgoings meaning general maintenance and repairs, council rates, taxes, sometimes management fees and insurances. This setup is quite different from residential leases and can reduce the investor's overheads and headaches, because the tenant is covering that cost for you. For instance, you receive a $3,000 rates bill. You don't have to worry about that, because you know your tenant's covering it for you.
How good, mate. That's music to many investors' ears. I know people who've been blessed with the property and residential and there's no maintenance, and that's great. But then some people just have the short straw, and the first month is chaos, or the first year is chaos. It's a great point to pick up on commercial itself. Let's jump into number 4. What do we have on number 4?
So on number 4, we have rental increases. Commercial leases usually include clauses for predetermined rental increases tied to CPI or a fixed percentage, or both. For instance, we just recently secured a deal. The clause read yearly increases of CPI or 3.5%, whichever the greater. So whichever, or it could say fixed 4%, whatever was negotiated at the time. The rental increase mechanism is in place because it creates a hedge against inflation, meaning your future cash flows are protected against the devaluation of the dollar. This means investors can anticipate and plan for income growth, something that's less predictable in residential sector, and hence why commercial investing is so attractive.
Yeah, those increases are gold because it's not a speculation then. It's built into your document and you know where you're going to be 3, 5, 7 years later. You know where you're heading. And it's usually the mortgage is either staying the same or going down, and then rents are going up. But a key thing for investors to look at as you do look at rental yields or rental increases, should I say, is that sometimes between option terms, you can have rental increases of 3%, say, for 3 years, 1, 2, 3. And then you have an option term of 3 years. But in between, it's important to keep an eye out on your lease agreements because there could be one section that says, well, review of rent back to market. And so what that means is if your market rent grew here, but your document of your lease went and your rent grew here, at the option term, you could have a reset point of market, which is negotiable and debatable, but it could reset. But then you go back on increases again. So it's important to pay attention to those micro details, which Chris always points out in his lease reviews. And Chris, the last one, the fifth benefit of investing in commercial property. What have you got for us?
Yeah, so we have diversification, and depending on what you purchase, diversifying your portfolio by including commercial properties can reduce risk because the commercial market often behaves differently to other markets. It can provide a safety net against market volatility, plus investing across different types of commercial assets, like, for instance, industrial and medical spaces, could spread the risk even further. For instance, the REIT that I was employed with had both retail and industrial assets in the portfolio. And during COVID, while retail was doing it tough, their industrial assets picked up the slack. So the overall portfolio was less impacted by market volatility because it was diversified, which is a solid strategy.
Awesome, mate. Well, 5 core benefits of commercial investing. And for the audience here who's been watching and listening and tuning into our mini shows, that's not going to be the last taste of Chris here. We'll be having Chris on many more episodes in the future. Can't wait to have your knowledge and detail on more points of commercial property investing. And commercial property investing will make a regular appearance here on the InvestorKit Property Show. So thank you so much, Chris. Appreciate you reaching out here and being on the show with us and sharing your knowledge on 5 benefits of commercial property. Now, for those who've been tuning into this episode and you're like, hey, these are great benefits to help me on my portfolio and I'm keen to make that transition and make that start, jump onto investorkit.com.au. We have a tab specifically on our services for commercial, and you can reach out and book a consultation there for commercial property. That's a free consultation for us to understand if we can help you start or scale a commercial portfolio. And where I find they best fit a portfolio is those who either A, have a large income producing business or high incomes with a deposit of circa 300,000 plus or equity of 300,000 plus putting towards commercial. And that's where they're looking at purchases of that sort of $1 million and upwards. Or B, those who end up having a few residential properties, have equity built up, and are now transitioning their portfolios to income generating assets. I hope this helps you in understanding more about the 5 benefits of commercial investing. More episodes like this to come in. And if you have any wish lists and you're watching this on your YouTube and you're like, I want to learn more about commercial, drop a comment, like and subscribe, and we look forward to hearing from you soon. Thanks again, Chris, and take care.
Thanks, Arjun. Cheers.